Hello, I'm Michael Gray, CPA. First, I want to thank those of you who follow Financial Insider Weekly on YouTube. As I record this, there are 1,369 subscribers, which is pretty gratifying considering that I'm no longer making these videos. The final episode of Financial Insider Weekly was broadcast by CreaTV in San Jose on August 24th, 2017. And basically what happened is I sold my CPA practice, and the person who bought the practice didn't want to continue the show. Although those interviews include valuable information, viewers should be alert for developments that happened after they were recorded. And that's one reason why we always say in those interviews that they should only be the beginning of a conversation with a professional advisor. On December 20th, 2017, Congress passed and President Trump approved the Tax Cuts and Jobs Act of 2017, and it is the most significant tax legislation in 30 years. I recommend that everyone should consult with a professional tax advisor about how they are affected. So here are just a few points to be aware of. First, those states that have an income tax don't necessarily automatically conform to federal tax changes, and this makes it easier to make mistakes when preparing your income tax returns, even with tax return preparation software. Second, the tax law changes have eliminated the tax benefits of home ownership for most Americans. The standard deduction was increased for 2018 to $24,000 for married persons filing a joint tax return, $18,000 per head of household, and $12,000 for individuals filing as single persons. The deduction for state and local income taxes plus real estate taxes is limited to $10,000, and the tax deduction for most miscellaneous itemized deductions, including employee business expenses, has been eliminated. So when you look at all these together, since most people are no longer going to be able to itemize, or many people, that means they are not going to get the benefits from home ownership. The so-called tax simplification to make a postcard federal tax return is really misleading. The other required information has been moved to other tax return schedules. There's really no change for the information required to be reported, except that many tax deductions were eliminated. So in a sense, you could say it's simplified because you can no longer itemize deductions. That means you use the standard deduction, so it's simpler. Okay, whoopee. Okay, number 4, the lifetime estate tax exemption was increased to $11,180,000 for 2018, which is more than $22 million for a husband and wife. And this means that very few Americans who die after 2017 and before 2026 will be subject to federal estate tax. Some states still impose inheritance taxes. I recommend consulting with your attorney about updating your estate plan and what to do with existing family trusts. Estate planning includes using living trusts, and those trusts are still going to be useful for avoiding probate and other non-tax reasons. Number 5, the choice of business entity environment has changed. All regular or C corporations are now subject to a 20% flat federal income tax rate. Some small corporations will pay more income taxes under the new tax law, but large corporations have received a huge tax cut. This tax rate reduction is supposed to be permanent, subject to federal tax law changes in the future. Small corporations also won't have as much tax relief because most of their income is paid as wages to their owners. The wages, of course, are going to be taxed at the individual tax rates for ordinary income. Number 6, the most complex new tax rule is the 20% deduction for qualified domestic small business income under Internal Revenue Code Section 199A. And I'd throw in that code section mostly because you're going to be hearing it. It's going to be a buzzword. The computation of the deduction is comparable in complexity to the passive activity loss rules, but the grouping and loss limitations are done separately. In other words, it's going to be a whole separate computation. The deduction applies to domestic income of U.S. businesses owned by individuals, estates, and trusts, including sole proprietorships, partnerships, limited liability companies, taxed as partnerships, and rental properties. The deduction is phased out for businesses that provide professional services. The Internal Revenue Service has issued proposed regulations explaining this deduction, but there are still many unanswered questions. Anyone with income from multiple businesses that are not C corporations should have their tax returns prepared by a tax return preparer, professional, and expect higher tax return preparation fees for 2018. The deduction is scheduled to expire after 2025. If you make a mistake, you could lose the deduction entirely. So that's why I say it's very important to get professional advice. Number 7, in our episodes about community giving, we talked about charitable community foundations. Some taxpayers will find it beneficial to use a donor-advised fund at one of these foundations to bunch their donations in alternative years, and that way they could possibly get over the standard deduction threshold and be able to itemize deductions and get some tax benefit from their donations. Number 8, the limitations for bonus depreciation and the expense election for business equipment have been increased. Used equipment now qualifies for bonus depreciation. Consider buying business equipment that you need now and putting it in service by the year end to get a current tax deduction. The trade-off for businesses that aren't C corporations is reducing the 20% deduction for qualified domestic business income and possibly having more taxable income after 2025, the year 2025, when the federal income tax rates for individuals, estates, and trusts are scheduled to return to pre-2018 levels. So in other words, you could be trading off a deduction in a low income tax rate year for a deduction for having income in a high income tax rate year. Number 9, for taxpayers with large capital gains, an important new tax advantage investment was created by the new tax law called Qualified Opportunity Zone Investments. When you invest capital gains incurred after 2017 and before 2026 into one of these investments, within 180 days after realizing that gain, the federal tax on the reinvested gain is deferred until December 31st, 2026. If the qualified opportunity zone property is held for at least 10 years and the taxpayer makes an election to do so, any additional gain from the ultimate sale or liquidation of the property, that's the replacement property that I was talking about, will be tax-free. Now remember, states might not conform to this federal tax law. The Internal Revenue Service recently issued some proposed regulations explaining the details for this tax benefit, but there are still unanswered questions. A few of these investments are becoming available. Number 10, although Section 1031 tax-deferred exchanges for real estate were preserved under the new tax law, Section 1031 exchanges for personal property, including business use cars, were repealed. these are just a few highlights of this new tax law. The IRS has issued publication 5307 called Tax Reform Basics for Individuals and Families. It's available at their website, irs.gov. And then there's also another item. It's FS 2018-17, which is Tax Reform Highlights for Businesses. You can search for that on the IRS website. Again, those are very sketchy explanations also. You really need to see a tax professional to see how this is going to affect you. The other thing that you might want to do this year is have your estimated tax situation reviewed. In other words, make sure that you've had enough withholding paid in so that you'll avoid estimated tax penalties. So with all of that, I want to wish you a happy holiday season and a prosperous 2019. And thank you again for watching Financial Insider Weekly.